Hey everyone, welcome back to another explainer. I am absolutely pumped you're here today because we are looking at a literal masterclass in macroeconomic contradiction. Right now, in Q3 of 2026, the financial world is behaving in ways that seem entirely upside down. We're seeing slower overall growth and mounting consumer debt perfectly coexisting with record-breaking stock valuations and explosive AI growth. It's a massive puzzle, it really is. But we're going to break it down step by step using the data right in front of us. Let's get right into it.
So it all really kicks off with this one kind of maddening question, right? Why on earth is fundamentally bad economic news currently pushing the stock market to absolute record highs? It's cognitive dissonance at its finest. You'd normally think a slowing macroeconomy would terrify investors, but instead it's actually fueling peak valuations. The sheer mystery of this is just fascinating. To really understand why this is happening, we have to look closely at the massive divergence occurring right beneath the surface of the broader economy.
To figure this out, we've got a pretty clear roadmap today. We're going to hit 1, the macro market paradox, 2, the AI valuation wedge, 3, corporate winners and losers, 4, the two-speed consumer, and wrap up with 5, testing the equilibrium. Let's dive in. All right, Section 1, the macro market paradox, economic divergence. Just take a look at the startling contrast here. The labor market is actively contracting. We literally saw a surprise drop of 23,000 jobs lost in July. That was a huge miss compared to the expected 83,300 gain. Plus, May and June both revised downward. The only tiny bright spot was manufacturing squeaking out 5,000 jobs. But here's the crazy part. Counterintuitively, in that exact same window, the S&P 500 reached a record high of 7,757, and the Nasdaq climbed 1.3%. This labor contraction didn't spark any kind of recessionary panic. It actually renewed risk appetite. Now, the mechanics behind this whole bad news is good news vibe are actually brilliant. Just follow the logic flow here. When the labor market softens up, like those 23,000 lost jobs, wage pressures drop. And when nominal wage growth slows down, inflation fears kind of just melt away. This basically tells the market that the economy can grow without the Federal Reserve constantly slamming on the brakes. Because of this, the Fed's flexibility increases, and traders are suddenly pricing in a 56% probability of a September rate cut. That compresses the equity risk premium, meaning investors demand less extra return for taking on risk, which ultimately leads to expanding valuations. So what does this mean for you? Well, as long as the economy cools just enough to lower inflation without totally crashing, Wall Street views the path of least resistance as straight up. Moving on to Section 2, the AI valuation wedge, boosting expectations. So the absolutely crucial thing to grasp here is exactly how much AI is boosting expectations. Corporate claims of AI-linked efficiencies are being extrapolated to an average 150 basis points, or 1.5%, improvement in margins. This AI efficiency boost is literally creating a bridge from our current S&P 500 base of around 7,757 and driving target valuations significantly higher. I mean, JP Morgan has set a year-end target of 8,000, and 22V is projecting a 12-month target of 8,500. This margin expansion is heavily favoring cyclical stocks over your traditional defensive plays. But listen, this is definitely not a rising tide lifting all boats situation. We are actually watching what analysts are dramatically calling the SaaS apocalypse. Traditional SaaS companies are just collapsing right now. Take Rattle, for instance, valued at over $100 million back in 2021, and now they're pushed to the brink because AI is basically automating their entire administrative niche. Or Trade Desk, taking a 22% hit on a revenue miss. But on the flip side, generative AI-linked platforms are absolutely soaring. Airbnb's stock just jumped 17%, making it the S&P 500's biggest gainer, and that was based entirely on raised forecasts that explicitly cited AI-driven improvements to its global platform. And we're seeing this massive divergence play out in global hardware supply chains too. We are currently facing a major geopolitical memory crunch. Over in China, CXMT has managed to capture 7% of the global conventional DRAM market, and they're projecting a massive jump in high-bandwidth memory supply by 2028. This expansion is directly squeezing Apple, which basically means the cost of making your next iPhone is going up due to soaring memory chip prices. Meanwhile, domestic priority stocks are practically shielded. Look at Micron. They are up 3x this year, heavily protected by U.S. domestic priority in the AI server space.
Okay, Section 3, corporate winners and losers, strategies and behaviors.
Let's re-examine a classic rivalry through a 2026 lens, the Cola Wars. There is a stark contrast in their structural models right now. Coca-Cola is operating this premium asset-light marketing model since they sold off bottling operations, and it has them outperforming the broader market with a premium 26x PE valuation.
Their growth is primarily driven by Coke Zero. The bull case here is that they're structurally valued almost like an asset-light hospitality brand now. Now compare that to PepsiCo. They rely on a vertically integrated, capital-intensive supply chain anchored by food and snacks like Frito-Lay. Because of that heavier operational footprint, they are currently sitting at a much lower 16x PE. Sticking with food for a second, history gives us a surprisingly tactical, if slightly grim, playbook: trading the food scare alpha. Currently, we're seeing aggressive sell-offs. Yum Brands is down 10% from a cyclosporiasis outbreak, and Sweetgreen is down 30%. But, unless there is core systemic operational negligence, historical data strongly shows these steep drops are highly lucrative temporary buying windows. Think about it. Taco Bell back in 2006 rallied 31% the next year. KFC China in 2012 rallied 26%. Wendy's in 2022 rebounded 25% in a matter of months. And Chipotle in 2018 rallied an incredible 140% in 1 year following a CEO change. It's a proven pattern. Now, I just want you to take a moment and look at this number. $365 billion. That is just a completely staggering figure. And that $365 billion is exactly how much cash Berkshire Hathaway is currently hoarding. As an institutional barometer, this is a massive signal. While they're a net buyer of about $20 billion in stocks, this profound defensiveness, this massive cash pile, it signals that equities are perceived by some of the greatest capital allocators out there as just way too expensive right now. And meanwhile, over in private credit, we're seeing real strain. Default rates are hitting recent highs. If you analyze the top funds, loan health and investor returns are demonstrably worsening, which ironically severely contradicts all that highly optimistic public commentary we keep hearing from the fund managers themselves. All right, shifting gears to Section 4, the two-speed consumer Main Street reality. We are literally living in a tale of two economies right now: the foundational economy versus the experience economy. These two sectors of everyday life are moving at entirely different speeds, creating this deeply fractured, bifurcated consumer experience. And the starkest dividing line in this two-speed economy really comes down to one single heavy metric: 6.69%. That 6.69% is the current 30-year fixed mortgage rate, and it is the absolute primary culprit keeping the foundational economy completely frozen. Because rates surpassed year-ago levels, housing is just locked up. Zillow and Rocket are reporting the toughest market they've seen in years, with Q3 volume expected to shrink to historic lows. And look, if you aren't buying, renting is equally brutal. Check out this rent squeeze. San Francisco's average asking rent jumped 18% in under 2 years to $3,728, aggressively fueled by the localized AI boom. Housing and essential living costs are basically operating like a demolition derby right now, aggressively draining capital from everyday renters and prospective buyers. The only tiny silver lining: unpredictable rates have reduced buyer competition, so cash-heavy or unleveraged buyers might actually see slower price growth. But if we pivot away from the essentials and look over at the experience economy, it is an absolute manic boom. Discretionary spending is at unprecedented levels. People are treating travel like a non-negotiable essential now. We're seeing a supercharged, wealthier upper middle class funding a projected 24 million trips to Europe in 2025, which is a record high. And the return of cultural monoculture is real. The summer box office hit $4 billion, with ticket sales 22% above last summer. I mean, just look at the new Spider-Man, Brand New Day. It pulled in $1.67 billion worldwide. FOMO and premium formats are driving massive spending on shared cultural events, moving at breakneck speed compared to that frozen housing market. Which brings us to our final part, Section 5, testing the equilibrium of fragile balance. So right now, we are suspended perfectly in this AI-driven Goldilocks zone, but it's a delicate balancing act on a very, very narrow tightrope. On one side of the scale, you have the drop risk. This happens if AI fails to actually deliver that promised 1.5% margin boost. If that fails, the whole valuation bridge collapses. On the other side, there's the overheat risk. If we get a hot inflation print, it shatters the implied GDP speed limit, destroys the rate cut thesis, and revives stagflation fears right back to the surface. But right at this exact moment, the S&P 500 is perfectly balanced. Labor is cooling just enough to invite Fed cuts, while AI boosts efficiency just enough to justify those 22x plus valuations. So what should you take away from this, and what should we be watching?
Well, our look-ahead radar points directly to Wednesday. We have two massive stress tests hitting at the exact same time. First up is the inflation threat, the consumer price index print. A hot print over the 2% target completely stalls that 56% probability of a September rate cut and is going to confuse markets aggressively. Second is the AI viability test. We've got tech infrastructure earnings coming from heavy hitters like CoreWeave, Supermicrocomputer, and Cisco Systems. The market requires absolutely pristine forward guidance from these companies to justify the AI margin expansion, keeping equities at record highs. If they miss, that valuation bridge we talked about earlier could seriously crack. Which leaves us with this final, critical question to ponder. As the foundational economy stays frozen solid and tech valuations continue to skyrocket, will this precarious, AI-driven Goldilocks equilibrium actually hold its balance? Or are we standing right on the edge, just waiting for the great divergence to finally snap? Keep your eyes closely on those Wednesday data prints, everyone. That is going to be the ultimate test. Thanks so much for walking through this explainer with me, and I'll catch you next time.